What's up, everyone? It's Eric with Option Edge, and today I'm showing you a trigger and trade in Shopify. Today, Shopify crossed up through its 200-day moving average and closed above its 200-day moving average. Okay. Historically, for many stocks, this is a very good trigger to get long. Okay. So I'm going to show you a good back test, some historical back tests, and we'll evaluate what we're going to do here. All right, so I'm back on my handy dandy Trade Machine Pro backtesting software that I like to use a lot. So here's the trade. It's selling the 40 delta, buying behind that, the 30 delta puts. Duration of the trade, 30 days. And I'll show you the technicals here real quick. We're going to close this trade out with a gain of 50% or more at the end of the day. My plan is if this becomes a losing trade, I usually like to sell a call spread against this, but we'll get into that another day. I've actually made a video about that, and I can link to that above, how to hedge your losing spreads. But let's get into the technicals. So the technicals are, we want the stock to cross up through and close. It has to cross up through and stay above the 200-day moving average. Stock has to be above the 10-day exponential moving average. It is, and the stock has to have its RSI below the 70 or the overbought mark. All of these parameters check off. So we can go into Robinhood and take a look how to set this trade up. All right, we're in Robinhood and we're looking at Shopify. So let's go ahead to options. The options chain, we want to select something that's 30 days away from today. So January 28th might be about 31 days, but that's the closest expiry we want to choose. And we want to select sell, and we're going to select put. And let's get below currently. Let's see here. I believe I sold the 1365, which is the 41 delta. Technically, the 1360 would have been right on the 40 delta mark. Okay, so I sold this, and remember the back test is sell the 40, buy the 30. So the 30 delta, let's keep going. 30 delta is probably right about 1315. Okay, so we're looking at a put spread. Okay, that is a put spread that is. We're looking at a put spread with which is 50 strikes wide. Okay, so that means we're risking $5,000 minus the credit received. So if this is the credit received, you do $5,000 minus or $50 minus 1665, which means our max loss is right here. If you can see that flipping from green to red, our max loss is $3,335. If you're like me, maybe you don't want to risk as much. So what I did, I went ahead and bought basically the 38 delta. Let's see here. It's really closer to 39 delta. Got a credit. I got into this trade for about $3.90. If you look at the pricing is pretty. You got some, not the most liquid options, but Shopify is a liquid name, so you shouldn't have too much of an issue getting a fill. It's just expensive stock, so things tend to get wide on that. So that's the trade, and I can show you what the back test looks like with the adjusted delta. So let's go back. All right, let's adjust these deltas. We're gonna do, let's do 39 delta and see how that works. So it's a pretty. All right, as you can see, good win rate, obviously 5-0 in the last about 3 years. If we click on the tile, we can look at our average win, $545. So that's the trade, everyone. Close out at 50%. As always, this is not advice, just for educational purposes only. Like and subscribe to my stuff if you enjoy this stuff, and peace out. Have a good night.